Crashing bond prices. This problem has bankrupted Silicon Valley Bank in March of 2023, and the world was shocked as there was actually no real bad news about banking. A sell-off in Treasury was an important reason for the collapse of the bank, and there's reason to believe that what triggered the California lenders' collapse may be haunting Wall Street again. There are signs of that. Bank of America shares have fallen 14% this year. Big banks are sitting on $650 billion of unrealized losses. This is an estimate from Moody's. It is a sign that even the Wall Street's best known names are feeling the heat from the Treasury-market rout. So why is there so much tension about this bond market sell-off which is happening right now? How does it really affect the bank balance sheet? And is this the new hidden threat which can crash the US economy and with it, the world economy? We will find that out till the end of the video. So let's try to understand what exactly is happening with this bond market sell-off. To understand this better, let's go back a little and try to understand what exactly happened with the SVB Bank, the Silicon Valley Bank. So why was the SVB important to the tech sector? Silicon Valley Bank provided financing for about half of all the US venture-backed technology and healthcare companies. SVB was a preferred bank for the tech sector because they supported startup companies. And not all banks would accept that because supporting a startup company is accepting high risks, and not all banks can do that. The pandemic in 2020 was a hot market for tech companies as consumers spent big money on digital services and electronics. Tech companies had a large influx of cash, and SVB's service were needed during this time to hold their cash for business expenses, such as payroll and other administrative expenses. So what basically SVB did was not only they provided funding to these startups, mostly tech and healthcare startups, and at the same time they would also hold their cash in their bank account so that there would be smooth functioning of their business. The banks actually invested much of these deposits, as banks typically do. They cannot keep the funds idle. They have to invest it somewhere. So Silicon Valley Bank used to lend out money in short durations. However, in 2021, this shifted to long-term securities, such as treasuries, for more yield. And they did not protect their liabilities with short-term investments for quick liquidations. So what happened then? They were insolvent for months because they could not liquidate their asset without a large loss. So if they had to, if they want to liquidate their asset, they have to take a loss. And that's what happened. They had to sell their treasury bonds. If they would have held on the securities till their maturity, there would have been no loss. But they had to sell it because of the capital pressure. So this is just one story, which actually we have here as an example, but now it's not over completely. The brutal treasury market meltdown has hit some of the largest financial institutions hard, dragging down the share prices of big names in the banking, such as Bank of America, and fueling fears that the turmoil triggered by the Silicon Valley Bank's bankruptcy may not be over just yet. Here's everything you need to know about unrealized losses, including why they are dragging on bank stocks and whether they could trigger another financial crisis. So let's talk about unrealized losses. Treasury bonds, debt instruments the government issues to fund its own spending, have been on a downward run since the onset of the pandemic. And why does this happen? Because with investors are fearful about rising interest rates and the long-term viability of the massive US deficit, and they start selling the treasury bonds. Now, here's a look at the BlackRock's iShare 20-plus year treasury fund. This is an ETF, and if you look at the ETF, which tracks longer duration debt prices, has plunged 48% since April of 2020. I just have the graph for a year back, but if you compare the prices from April of 2020, it has been down 48%. Now that is really something. Meanwhile, the 10-year treasury yields, which moved in the opposite direction to prices, spiked above 5%. for the first time in 16 years. So what we see here is since the May of 2023 till date, the yield has spiked to about 5%, and this is the 10-year Treasury bond. To understand more about the bond versus yield relation, please watch my video on bonds signaling a recession. I have placed the link in the description, which will provide in-depth insights on bond and yield relationships, and that will make it easier for you to understand the relation. As a result of that sell-off, some of the US biggest banks are now sitting on unrealized or paper losses with hundreds of billions of dollars at stake. That means the value of their bond holding has plunged, but they have chosen to hold on rather than offload their investments. Here's what it is. Moody's estimated last month that US financial institutions had raked up $650 billion worth of paper losses on their portfolios, and this is till September 30. Now, compared to June 30, this is up 15%, and that's all because of the Treasury sell-off, the bond sell-off, which is happening right now. The ratings agency data still doesn't account for October, which is the latest. They have not come up with the October numbers, but the numbers till September 30 are staggering. I mean, where the longer-term collapse in bond prices spiraled even more, and it has turned out into one of the worst routs of bond selling in the market's history. So these losses are not as same as the debt, however, which describes actual borrowings that needs to be paid. Bank of America is the big lender worst affected by the crash in bond prices, having disclosed a potential $130 billion hole in the balance sheet in the month of September. The other four banks, Citigroup, JP Morgan Chase, and Wells Fargo, have also raked up unrealized losses in tens of billions of dollars, which you can find in their earnings report, according to their second and third quarter earnings report. So these names are not small. The banks which we are talking about is Bank of America, Citigroup, JP Morgan Chase, and Wells Fargo. Isn't that the whole American banking system? Is there another SVB-style crisis coming up? Silicon Valley Bank failed in March after disclosing a $1.8 billion loss on its own bond portfolio, triggering a run on its deposits. And the companies which had deposit with SVB started withdrawing it at a fast pace. And that's the reason why the SVB could not stand, and they filed for bankruptcy. Similarly, big banks' huge unrealized losses are also sparking concerns among Wall Street doom mongers. So what the big concern is, the interest rates are higher, and they are going to be higher for longer. And analysts and economists say that higher for longer is a big problem, because the Fed signaling it would hold interest rates at about their current level well into 2024, and this is in order to kill the inflation. But what the analysts say is that a 6% plus Fed fund rate of banks could be, what the economists are saying is that a 6% plus Fed fund rate can be disastrous to the American banking system. And if this stays well into 2024, banks in America are near insolvency if we just deduct the losses from their equity. So it's important to remember that Bank of America's $130 billion losses are still unrealized. So what's the difference between BOFA and SVB? Unlike SVB, it isn't officially in the red yet because it has not sold its bond holding. So what would have happened if SVB would have held on those securities till maturity? The securities might have recovered by the end, and that's the functioning of, that's how the bonds function, and they would not have taken any losses. So right now what BOFA is saying that it's not a problem because we are not going to sell it. So the bank's CFO said that it's not a problem because we are not going to sell it, and he shrugged off that the market's worries on the last month's earnings call, and he said that most of the bank's fixed income portfolio was low-risk government bonds, and they are not going to sell it, and they're going to hold it to maturity. So if you hold a bond till maturity, the short-term fluctuations in the bond, or maybe fluctuations in their prices, or the bond sell-off which is happening right now will actually not affect their bond portfolio. That's what the CFOs say. All of these unrealized losses on government guaranteed securities, we are holding them to maturity, so we will not anticipate that we will have zero losses over time. That's what the CFO said. So there's a possibility that the Bank of America customers will pull their money out as they did with Silicon Valley Bank, but that hasn't happened. In fact, deposits are up and registered about 200,000 new accounts in the third quarter for Bank of America. So what we are trying to say here, the CFOs are denying it, and they're showing numbers of new accounts being opened. So there's no fear in the market anything happening to Bank of America. Some analysts also believe that the worst of the Treasury market rout is now over, with the Federal Reserve starting to signal that its tightening campaign is nearly done. And from the past two times, they have not raised the interest rates. So 10-year yields have softened in recent weeks, falling from 5% at the peak to 4.6% recently. But you know what? Go back to any time in history, and officials have never said, okay, there is a problem and we need to come up with a solution. They never have said that. And just before major crashes happening in history, everything was okay. According to the government, according to the CFO and the CEO of the companies, everything was okay. There was nothing wrong. Even before the recession of 2008, Lehman Brothers was in a good position, just like 15 days before their bankruptcy. They were all rated AAAs. So are banks really under pressure? Or what is the main idea of this video? What we are trying to address here is that even though the yields are softening now and the prices might recover a little bit, it doesn't mean the big four banks can afford to just dismiss the bond selling, the bond route. So banks are saying they are not selling it. So what's the problem then? So in the paper published earlier this year by the Kansas City Fed, concluded that the paper losses could still drag down a bank's share price. Now that's important. Unrealized losses can increase equity cost of investors, and there could be a perception that their financial health can deteriorate. Overall, banks have accumulated about $2 trillion in new securities since the start of the pandemic, and securities now constitute about one quarter of total assets at commercial banks. And this was at 20%, and now it's, before the pandemic, like in 2019, now it's 25% since 2020. So extra $2 trillion of securities has been added to their bond portfolio. These securities are not free of interest rate risk. That is, the risk that valuations will drop sharply should market interest rates rise. As a result, a larger fixed rate securities portfolio, even if it is composed of securities free of credit risk, makes bank balance sheet more sensitive to interest rate changes. And what happens when there is sensitivity? It all gets reflected into the stock price. And what I feel is it just takes one bad news or one bad valuation metrics to trigger a sell-off in equities, like we have always seen. And with this age of machine trading and bots trading Bank of America shares and Citigroup shares, there's one negative trigger which can create a sell-off into the banking system. And what has happened over the years is the bank has become very sensitive to the interest rate risk. The interest rate, if the other problem is if the inflation goes higher than like it reaches like 5% or 6%, then actually the Fed doesn't have any option but to increase the interest rate. And what happens when they increase the interest rate? And there could be further selling in the bond market. And then what would happen to these banks? Because then there will be, we'll see lax in lending volume. There will be less people wanting loans because it would be a problem that because of the higher interest rates, we'll see a problem with the mortgage market because the demand will slow down there. So there could be a lot of problems here with so much of securities held, which is at an interest rate risk. That's been happening this year. 3 of the 4 big banks have their stocks sliding. Predictably, Bank of America has been worst affected, with its stock down 24% over the past year and 14% year to date. So this is the graph for the top four banks in 2023, and you see how this is like a percentage chart. So we see the percentage negative in cases of Wells Fargo, Citigroup, and Bank of America, and since January this year. So the worst is the Bank of America. JP Morgan is still on the positive side. Worries over unrealized losses on sovereign bond holdings are also weighing on the US lender to again reflect concerns over rising interest rates and whether the US Federal Reserve will untimely tighten the policy for too much, or maybe keep this tightened policy too much for too long. So unrealized losses may not be about to trigger another financial crisis as of now, but as long as the bank stocks are down, they will remain a concern for Wall Street's biggest names. So what really in here is a massive problem which is going unaddressed, and to some extent the magnitude of the losses are underestimated